is the world economy heading into recession? But the Fed is looking to cut interest rates, but they're going to hold them higher for longer anyway? Wait a second. One of these is not like the other. Welcome to Macro Money. This is Ilya Spivak, head of global macro here at tastylive. And we're going to try to unpick what all is going on here, because the price action, the explanation for that price action, and the state of the global economy suddenly don't seem to add up. But of course, that's where trading opportunity lies. So we're going to try to unpick what exactly is occurring, where it's occurring and why, what the reaction function in markets is likely to be to reconcile this disconnect, because of course, reconciling that disconnect is precisely what will create the kind of market moves that we seek to trade, at least from a global macro perspective. And so we're going to first check in with where the global economy is. Then we're going to see what is likely to move this narrative one way or another from the economic calendar and actually from the earnings calendar as well this week. Then try to figure out what that means for asset levels and where the tradable areas of this narrative might be. So first, let's consider a broad-based look at the global business cycle. This is the JP Morgan Global PMI. As ever, it is operating on the familiar logic that PMI diffusion indexes use. 50 is the center line. At that level, neither manufacturing nor the service sector nor the composite of the two are growing or shrinking. Above 50, there is growth. Below 50, there is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. So if we consider where we are on the global economy writ large, we have had manufacturing in below 50, that is contraction territory, for quite some months now, indeed for the majority of this year. We got here through steady deceleration, largely because of a Fed rate hike cycle that has led other central banks along into a global tightening of credit. We've also seen that the impacts of the various adjustments made to supply chains have brought down costs. On the shipping side of this story, that has factored in to the pricing power for manufacturers. But the main catalyst here does seem to be the tightening of global credit. We likewise see that there has been a bit of a hangover from the robust stimulus that was provided during the pandemic, but that's been slower to filter out. And so as we got into the beginning of this year, there was a pop on the service side of the equation, seemingly as there was a re-engagement more broadly with the reopening of economies and the spending of money on services rather than goods. Goods, of course, the area of spending that was most prevalent during the pandemic because everybody was on lockdown. Folks were not going to restaurants and concerts and traveling quite so much. In fact, almost not at all during some parts of the lockdowns where they were the most coordinated. The situation really started to shift in earnest and with vigor toward the end of last year as we got more broad-based reopening, and so more spending on services really starting to broaden out. So there was a pull there, which now seems to be coming undone. We can see that the bump to services seems to have crested already at the global level. Those services growth numbers are coming in That's that orange line that you see on the screen there. Services, of course, the largest component of overall growth. And so as services were able to pull overall growth, the composite index there higher, in a veering away from manufacturing, so too now there is apparently convergence. And so rather than seeing convergence on the upside where manufacturing catches up higher, we instead see that dividend to services being spent down, a slowdown there, converging downward toward manufacturing. So the overall story seems to be of a global economy that is in broad strokes slowing. The catch-all there, the composite index, which has clearly turned a corner and is getting closer to 50, having been further away. So we are still growing. We're still above 50, but the rate is very clearly coming down. This is a story that isn't specific per se to developed or emerging markets. Here is an isolated view of developed markets. We can see the very same story here. Manufacturing still in deep decline, and services having crested, decelerating and driving overall growth lower. We see the same thing in emerging markets. Though here, manufacturing is idling, not quite shrinking outright, but here also, services have crested. That's pulling down overall growth. So that's the backstory. That's the backdrop for what's occurring. This much seems certain. Now, the next question in this story is, well, where's the pain? What's driving this? What's the scope for it to continue versus not continue? And here, a familiar chart. So we can see here, over half of the global economy is just three major markets: China, the Eurozone, and the US. That's 57% collectively of global GDP. If we consider that much of the rest of the pie, the other 43%, are economies that are vendors, dependent on demand from the large three, the amount of growth that those large three are responsible for is actually much greater. That 57%, that's actually understating the state of affairs here. Because in that rest of world number is, say, Australia, for whom China is overwhelmingly the largest export market. There is Canada, for whom the U.S. is quintessentially the driver of economic conditions and the source of demand. So too is Mexico, for the same reasons. So too is Central Europe, dependent as it is on Eurozone demand. And indeed demand from a relatively narrow core of the Eurozone. The richer, larger economies like Germany, France. So what we're looking at is really a three-legged stool holding up the global business cycle, and we can already see, looking at the prior numbers that we just saw on the PMI side of things, that there is weakness here already. Things are decelerating already. So what we're going to do here is we're going to look at each one of these areas and consider the state of affairs. So here's the Eurozone. And again, we're looking at vast kind of catch-all metrics here just to get a bird's eye view, or indeed a Martian level view, very much top down. If we take a look here at what's going on in the Eurozone, that key composite index that holds together both manufacturing and services, scaled for their contributions, not equal weighted, but scaled for their contribution. Services, of course, much larger than manufacturing. The Eurozone apparently is in contraction mode already. Now, Germany's economy shrank in the second quarter. It is the region's largest. These numbers are for July. That's the latest update. It seems to suggest that the weakness we saw in Germany is spreading to a region-wide situation, and so the Eurozone might well be in recession already. If one has not been confirmed, then we are certainly just on the cusp. So, by all accounts, the Eurozone part of the pie, those three key nodes of growth, that part is misfiring. Let's consider China. Not quite contracting here yet, but certainly getting close to it. One might have expected that there would be more vigor here, considering we've just reopened from COVID lockdowns in December of last year. But of course, that's also been the main issue for China. They reopened into a world where their end demand customers, the Eurozone and Western Europe in general, and the US, most importantly, they'd reopened almost a year earlier and were already spending down dividends from stimulus during the pandemic and facing aggressive rate hikes from their respective central banks. So growth there was already on the decline. China's main export market simply didn't come back with the kind of demand that China could count on before the pandemic. Business was just not there like that. And so the recovery is fizzling. Initially, it was manufacturing. You can see that turned lower relatively early. It seemed to crest around January, February, and has since slipped back into contraction territory. Then we can see the dividend from reopening that seemed to boost domestic demand. That's that services jump in the orange line. That crested relatively quickly as well, though a little bit after manufacturing, seemingly somewhere around the end of the first quarter, and has since precipitously declined, such that we're getting close to idling at this point, 51.1 on the composite index. Data that we saw last week on the trade side of things, on the inflation side of things, all pointing toward weakness. In fact, the economy actually slipped into deflation as of the last set of numbers. We're going to get some more data to inform this narrative this week: retail sales, industrial production numbers, housing numbers, foreign direct investment numbers, all of which seem like they are going to paint a darker picture. At least that's what the expectations are lining up to show. And the trend in Chinese economic data has been toward disappointment relative to forecasts. Just by way of example, retail sales expected to grow 3.1%, a slowdown. The fixed asset investment number, essentially corporate investment, expected to grow 3.4%, down from 3.8%. So the story here likely to remain underwhelming, it would seem. If we consider what's going on here across another measure of PMI, an analogous measure of PMI, this one CFLP is from official sources. China actually has another set. This is a private sector set done with S&P Global and Caixin. Very similar story. Slightly different overall numbers, but essentially the same narrative. Manufacturing in contraction, services fading, the composite index nearing idling. So what this tells us is that of the three key areas that drive growth, the three engines that power the global economy, the Eurozone seemingly in trouble, China seemingly in trouble. That leaves the US. This is where we're likely to see important news flow shape the narrative this week. Not only because this is the sort of last bastion of defense against the global recession, but also because it informs the actions of the Fed. And as we've discussed, the Fed is by far the most important of the major central banks because the dollar is the quintessential unit of global commercial exchange. When the Fed alters the cost of borrowing dollars, it's altering the cost of borrowing, period. Almost everywhere in the global economy, with the possible exception of excluded bits and pieces, like North Korea, maybe increasingly Russia. In the case of the US, it seems like the situation is still holding up, at least for the service sector. The ISM survey here is a little bit more timely. It came out a little bit later than did the PMI numbers. So we'll look at that here, but the logic is the same center line at 50. And you can see here that both have been decelerating, manufacturing and services, but services appears to be somewhat idling rather than catching up lower as we've seen elsewhere. Manufacturing is certainly still in contractionary territory, but services seemingly holding up, and most importantly, not really trending lower at this point so much as it is idling above 50 in a range. So the sense is that while the situation in China and in the Eurozone appears to be going from some baseline level to a level that is weaker, and there is a trend going weaker across both sides of the equation, for this, at least the service side seems to be not getting worse, at least for now. So it would appear that the U.S. economy is indeed a bulwark, again, for now, against global recession outright. That is not altogether durable if we consider that U.S. economic data seems to be showing some initial signs of rolling over. Now, this is very importantly a relative measure. It does not tell us whether U.S. economic data is good. It does not tell us whether it's bad in absolute terms. What it tells us, and this is a measure from Citigroup, is how U.S. economic data is performing relative to expectations. Now, this is actually critically important because markets don't necessarily move on how the economy is doing. Markets move on how their expectations for how the economy is doing stack up against what actually occurs. And if they are wrong, then they need to buy and sell assets to readjust exposure, which is what creates volatility. If there were not that uncertainty, markets wouldn't really move because there would be nothing to adjust for. So what we see here is a situation that we haven't seen since back in late March, early April. This economic surprise index has fallen for 2 consecutive weeks. Now, it's still above the zero line, and what that means is that U.S. economic data still has a tendency to outperform relative to forecasts. But the vigor with which it can do that, the momentum that's propelling data outcomes north of forecasts by an increasing margin, that appears to be fading. And the last time that we got a back-to-back set of weeks of decline in this index was indeed where the data really turned. We also have, tellingly here, a move through the 20-day moving average, which is exactly what we saw last time as well. So the monthly trend seems to be violated. This is daily data. There's about 5 days in a week. about 4 weeks in a month, hence a 20-day moving average. 5 times 4. So we seem to have some kind of a rolling over here. And the data that we've seen over the past several weeks, and indeed we can just keep it to the past week and some change, seems to follow in this vein. Non-farm payrolls, a little bit softer than expected, even though the unemployment rate was a little bit better. CPI, a little bit softer than expected. Consumer confidence, as we'll see in a moment, a little bit softer than expected. So we have seemingly some signs of weakness starting to emerge, if only in relative terms. If that starts to carry forward, does the global economy still have a leg to stand on if it's only the U.S. economy that's the remaining one? Well, maybe not. And powering the U.S. economy is, of course, the U.S. consumer. Household consumption is anywhere between 70 to 75% of U.S. GDP growth. And on that score, we're going to get some critical data this week. July's retail sales numbers are due to cross the wires. And here, the expectation is for a 0.4% gain after a 0.2% rise in the prior month. Now, as you can see, this is relatively sideways moving data. It's kind of oscillating here around zero, but nevertheless, an influential number when the U.S. consumer is so much in focus as the last bastion of defense against a broader turn in the global business cycle. And so if there is a soft patch here, then perhaps sentiment starts to recalibrate. And the odds of a global recession start to grow. That, of course, wouldn't bode well for stocks, would probably be supportive for the situation going on with the U.S. dollar, which now is working on a fifth week of gains. Here's that consumer confidence number from Friday to suggest that maybe this is the direction we might be going. The headline number down for the first time in 3 months thereabouts. That's that sentiment index in red. Not because current conditions got any worse. In fact, that index got a little bit better, but because forward-looking expectations have dipped and pulled it lower. So maybe there is, in fact, scope for retail sales to be a little bit soggier if, in fact, consumers seem to be getting a little bit less cheery about where the overall direction leads. Now, where all of this gets really interesting and why all of this ultimately lands with a view on the Fed is what has been happening with policy expectations and how it's fed the perception of all of this as we get minutes from the Fed's July meeting coming right on the heels of that retail sales report. Here's the implied Fed policy curve. So we can see here, there hasn't been a whole lot of change in the past week at the front part of the outlook going out to 6 months. From 6 months thereafter, there's been a meaningful steepening, and the steepening has been more pronounced the further out you go. So the current curve marks a meaningful upshift from the curve a week ago at the 2-year Tanner, at the 3-year Tanner, at the 1-year Tanner, not before. And all of it, at least up to about the 2-year Tanner, is a little bit more dovish than where the curve was after the last FOMC in July. That, of course, makes the market sensitive to this sense that they misread that FOMC. It was, in fairness, very vague. The Fed was quite noncommittal. But if the conversation at that meeting that is ultimately telegraphed in the FOMC minutes, which, by the way, is a massage document. It's not an exact accounting. So the Fed, very much knowing that the markets are looking for clues here and having talked about pouring cold water on rate cut expectations, will have probably released a statement in line with other guidance. That minutes document may well show that the Fed isn't quite as dovish even in the near term, that the odds of a September rate hike, say, or a November one, are more pronounced than the market has allowed. That would be a shift at the front end of the curve. If that occurs alongside a soggier view on consumers, well, then the odds of a global business cycle downturn of some kind looks that much greater. If we look at where the overall policy path is, important to note here, last week's readjustments, which the market dubbed as evidence of a higher for longer perspective, with some reason, didn't really touch, as we just saw, the front end of the outlook. The odds of a September rate hike still minuscule at 11%. The odds of one in November still less than even at 40%. So the market still thinks that the rate hike cycle has already peaked. That hasn't changed. We can see that here. What has changed is how much longer these rates will remain. Looking at the March numbers in particular here, there is now a 39% chance of a cut in March. As of the start of last week, that was closer to 80. So it would seem that, in fact, there's been a shift. If we look at the implied rate column for December, that's now at 4.25. It was at 4 this time last week. So it seems like one full cut has fallen out of the forecast over the course of the rest of this year and all of next. But if, in fact, we are going to get a Fed that signals more of this, nobody is cutting anything in a hurry, at the same time that there is weakening in the perception of the U.S. consumer because the retail sales number is a little bit weaker, because the perspective from some of the big box retailers due to report second quarter earnings this week, Walmart, Target, Home Depot, if that guidance in particular, not so much the headline earnings readings, but the forward-looking expectations, if that starts to signal that perhaps the U.S. consumer is a little bit less optimistic than the global economy would want U.S. consumers to be, given this is the last line of defense, seemingly at least, well then, all of what we saw last week with a readjustment to a higher for longer Fed via weaker stocks and a stronger dollar, that probably continues. But the sense that yields are as high as they are maybe doesn't. And so perhaps bonds go up. And the more defensively minded Japanese yen joins the dollar on the upside, having weakened precipitously. Because perhaps it is not so much that it's higher for longer that we're concerned about. Not so much what the Fed will do or won't do, but what it has done. That's important. Still the Fed, but the global business cycle pain it has wrought, and other central banks with it. And of course, China too, in no small measure. Perhaps that is increasingly the narrative that we're going to face. And in that world, it's still a stronger dollar, still weaker stocks, but also a stronger yen and probably stronger bonds too. And that is Macro Money for today. Thank you very much for joining me. As ever, I am here Monday through Friday, right after Overtime, which is a show that I do with Head of Futures and Forex, Chris Vecchio, here at Tasty Live, where we break down the day's events and try to figure out where they might be leading. I'm also on with Chris for Futures Power Hour on Friday, on with Tom and Tony for First Call on Sunday evenings, opining on tastylive.com's news and insights section. In fact, there's a summary of this very conversation there currently. And also writing on Twitter, yes, Twitter, at Elias Pivak. Thanks very much for joining. See you tomorrow.